Gross investment is referred to as the total expenditure that is made for buying capital goods over a time period, without accounting for depreciation. In other words, gross investment is the amount that a company has invested in particular assets or the business as a whole without considering depreciation for the same. Net investment, on the other hand, is the actual addition that is made to the capital stock in a given period. Net investment takes into account the depreciation and is calculated by subtracting the depreciation from the gross investment. Hey there, welcome to the Daytime Dollar, where we talk about financial strategies and how small changes can make big improvements. Today we are talking about gross investment and net investment. If you are new here, subscribe to my channel and hit the bell icon for more informative and amazing videos. So let's get into it. Gross investment and net investment. Watch more to know about gross investment and net investment and also learn about their differences. Further, this video also explains the functionality and importance of both gross investment and net investment. Gross private domestic investment (GPDI) is a measure of physical investment used to calculate GDP, which is used to measure a country's economic activity. This is an essential component of GDP since it serves as a forecast of its future productive capacity. It covers replacement purchases as well as net capital asset additions and inventory investments. It was 14.9% of the GDP from 2002 to 2011 and 15.7% of the GDP from 1945 to 2011. Gross investment less depreciation equals net investment. It is by far the least stable of the four components of GDP. The total amount of money spent on capital assets minus the cost of depreciation is referred to as a net investment. This number represents the actual cost of durable assets, such as plants, equipment, and software that are used in the company's operations. A firm's amount to maintain and improve its operations is a net investment. The company is expanding its capacity if the net investment is positive. Its capacity declines if the net investment is negative. Advantages of net investment. In general, a good value aids the company's ability to stay in business. Analyzing it will assist investors and analysts in determining the company's commitment to the business and its shareholders. The value can also be used to determine how capital-intensive a company is. The amount of money spent on asset acquisition by a company is known as net investment. Property, plants, equipment, and other forms of assets are examples of capital assets that help a corporation increase its productive capacity. Depreciation is subtracted from gross investment to arrive at the net investment amount. Wear and tear on fixed assets depreciates their value, as does the asset's obsolescence. As a result, subtracting non-cash depreciation from capital expenditure yields an appropriate asset value. It is a more accurate predictor of a company's asset investment than gross investment. It is also a leading indicator for determining a country's economic production capacity. It's a part of a country's gross domestic product. The cost of real estate is included in the gross domestic product of both private enterprises and governments. It shows how much a company's or a country's production capacity can handle. It shows if the value is rising or falling. A positive score shows that production capacity is growing or increasing. On the other hand, a negative score implies that production capacity is dwindling. The net investment is positive when the gross investment exceeds the depreciation, and it's negative when the gross investment is less than the depreciation. A corporation or a country must invest an amount equivalent to the total depreciation to ensure that the net investment is positive. The asset base will not decline as a result of this. For a few years, a negative value is acceptable. However, if this occurs for an extended time, it indicates that the company or country is uncompetitive. Net investment and gross investment difference. The overall expenditure on purchasing capital goods over a certain period of time, excluding depreciation, is referred to as a gross investment. On the other hand, net investment takes depreciation into account and is determined by subtracting depreciation from gross investment. The amount spent on purchasing financial assets is referred to as an investment. The goal of investing is to get a decent target return over a set period of time. The target returns could be in the form of an increase in the value of assets or securities, for example. It can also refer to a steady income stream from investments or assets. Investing can be classified as autonomous, induces, financial, real, planned, unplanned, gross, or net. The amount spent on purchasing or building new capital goods is referred to as a gross investment. The terms net investment and gross investment are interchangeable. It's basically gross investment minus existing capital depreciation. This depreciation is linked to an investment that must be made to replace old-fashioned or worn-out assets, such as plants and machinery. Or, to put it another way, net investment equals gross investment minus depreciation. If gross investment exceeds depreciation during any period of time, the net investment is positive, implying that the capital stock has increased. Similarly, if gross investment exceeds depreciation, net investment is negative and capital stock declines. Consider the following scenario. A manufacturer has 20 machines at the start of the year. It funds the purchase of 5 computers. 10 machines have reached the end of their useful lives. The gross investment now refers to purchasing new machines, which totals 5, while the total number of operational machines at the end of the year is 21. This results in a net gain of 1 machine. Thus, gross investment refers to the entire amount spent on products to generate other commodities and services, whereas net investment refers to increased productive stock. Conclusion. As a result, in any economy, these investments are important. One defines the overall expenditure on assets in the business, as in this case. On the other hand, it denotes just a new asset investment. So guys, that's all about today's topic. See you soon in the next video. Goodbye.